Ever wondered which ETF is better for long-term growth, VOO or SCHD? Well, you're not alone. We're going on a deep dive to tackle this question head-on, scrutinizing two of the most popular exchange-traded funds on the market, the Vanguard S&P 500 ETF or VOO and the Schwab US Dividend Equity ETF, known as SCHD. We'll be peeling back the layers of their performance from the broad market exposure of VOO, heavily weighted towards the tech industry and growth stocks, to SCHD's focus on high-quality, dividend-paying companies in defensive sectors like consumer staples, energy, and healthcare. Our analysis will cover over a decade of historical data, including compound annual growth rates and a backtest of a hypothetical $100,000 investment in each ETF from 2011 to mid-2025. So, which of these ETFs is a better fit for your portfolio? Let's dive in and find out. First, let's understand what VOO is. The Vanguard S&P 500 ETF, known by its ticker symbol VOO, is an exchange-traded fund that aims to track the performance of the S&P 500 index. This means it provides broad exposure to the 500 largest U.S. companies, giving investors a piece of the overall U.S. stock market. It's heavily weighted toward information technology and growth stocks, which have been the primary drivers of its impressive performance over the past decade. Looking at its track record, VOO boasts substantial compound annual growth rates and total returns. This is largely due to the strong growth of the tech sector, which has consistently outperformed other sectors in recent years. With an extremely low expense ratio of just 3 basis points, VOO offers a cost-efficient way to invest in the U.S. stock market. VOO has consistently delivered strong returns, but it's not the only option out there. Now let's take a look at SCHD. Schwab US Dividend Equity ETF, or SCHD for short, is a unique player in the investment game. Unlike VOO, SCHD doesn't try to track the entire market. Instead, it focuses on high-quality, dividend-paying companies that demonstrate strong financial health. These companies often come from defensive sectors like consumer staples, energy, and healthcare. SCHD's strategy is about providing a steady stream of income, rather than purely chasing growth. Over the past decade, SCHD has shown a commendable performance. Its compound annual growth rate and total return may not match VOO's, but they're still impressive in their own right. What sets SCHD apart, however, is its higher dividend yield. This yield is a result of SCHD's focus on companies that consistently pay out dividends, and it's this consistent income that can be particularly appealing to certain types of investors. SCHD's higher dividend yield may appeal to certain types of investors. Now that we understand what VOO and SCHD are, it's time to compare them head-to-head. VOO and SCHD, while both popular ETFs, have different focuses and strengths. VOO, the Vanguard S&P 500 ETF, tracks the S&P 500, providing broad exposure to America's largest companies. It has a heavy weighting towards information technology and growth stocks. Over the past decade, VOO has consistently outperformed SCHD in terms of total return and compound annual growth rate. This is largely due to the robust growth of the tech sector, which forms a significant portion of VOO's portfolio. On the other hand, we have SCHD, the Schwab US Dividend Equity ETF, which targets high-quality, dividend-paying companies with strong financial health. This ETF emphasizes defensive sectors like consumer staples, energy, and healthcare. While SCHD's total return and growth rate trailed behind VOO's over the past decade, it offers a higher dividend yield, making it attractive to investors seeking consistent income. Let's dive deeper into the numbers. If we hypothetically invested $100,000 in each ETF in 2011 and held until mid-2025, VOO would have grown more significantly, driven by the tech sector's strong performance. However, SCHD would have provided a steady stream of dividends throughout that period, adding to its total return. In terms of expenses, VOO has an extremely low expense ratio of just 0.03%, making it a cost-effective choice for investors. SCHD's expense ratio is slightly higher at 0.06%, but still highly competitive by industry standards. It's also worth noting the drawdowns of both ETFs during the 2020 market crash. Despite SCHD's focus on dividend and quality, it didn't offer significantly more protection than VOO during this extreme downturn. This suggests that while SCHD may provide a higher dividend yield, it doesn't necessarily mitigate downside risk in volatile market conditions. As you can see, while VOO has outperformed SCHD in terms of total return, SCHD has a higher dividend yield. Ultimately, the choice between the two will depend on an investor's individual financial goals and investment horizon. But what about during periods of market turbulence, like the 2020 COVID-19 crash? When the pandemic hit, it sent shockwaves across the global economy, and the investing world was not spared. All sectors were affected, and even the most robust portfolios experienced significant drawdowns. Let's take a closer look at how our two contenders, VOO and SCHD, weathered this storm. VOO, with its broad exposure to the S&P 500, experienced a substantial drawdown during the crash. The heavy weighting towards information technology and growth stocks was a double-edged sword, leading to high returns in good times but also significant losses when the market tumbled. On the other hand, we have SCHD, which focuses on dividend-paying companies with strong financial health. With its emphasis on defensive sectors like consumer staples, energy, and healthcare, one might expect it to have fared better during the crash, offering a kind of safety net. However, the reality was somewhat different. SCHD also experienced a significant drawdown similar to that of VOO. This suggests that the dividend and quality screening of SCHD did not provide a substantial cushion against the extreme market shocks triggered by the pandemic. What does this mean for you as an investor? Well, it's a reminder that no investment is immune to market volatility. High dividends and strong financial health are attractive attributes, but they don't guarantee protection against downside risk during turbulent times. It also underscores the importance of diversification and having a balanced portfolio that can withstand market ups and downs. So, while SCHD might appeal to investors prioritizing income and stability, especially those nearing retirement, it's worth noting that during the COVID-19 crash, its focus on dividends and quality didn't offer substantially more downside protection than the more growth-oriented VOO. Despite SCHD's focus on dividends and quality, it didn't offer substantially more downside protection during the crash. So, which ETF is better, VOO or SCHD? That's the golden query, isn't it? The answer, as we've seen, is not as clear-cut as you might expect. Each ETF has its unique advantages, and the best choice for you depends on your individual investment goals, risk tolerance, and time horizon. Let's recap VOO. The Vanguard S&P 500 ETF tracks the S&P 500, providing broad exposure to the largest U.S. companies, heavily weighted toward information technology and growth stocks. Over the past decade, VOO has consistently outperformed SCHD in terms of total return and compound annual growth rate, thanks largely to the tech sector's robust growth. Its expense ratio is extremely low at just 0.03%, making it a cost-effective choice for investors. On the other side of the coin, we have SCHD, the Schwab U.S. Dividend Equity ETF. SCHD focuses on high-quality dividend-paying companies with strong financial health, emphasizing defensive sectors like consumer staples, energy, and healthcare. While its total return and compound annual growth rate have trailed those of VOO, SCHD offers a higher dividend yield, making it an attractive option for investors prioritizing income and stability. What's more, during the COVID-19 crash, both ETFs experienced similar drawdowns, suggesting that SCHD's dividend and quality screening did not markedly reduce downside risk in extreme market shocks. This is an important consideration for risk-averse investors. So how can you use this information to inform your investment decisions? First and foremost, consider your financial goals and time horizon. If you're a long-term investor seeking robust growth, VOO may be the better choice for you. On the other hand, if you're nearing retirement and looking for a steady income stream, SCHD might be a more suitable option. But remember, investing is not an either-or proposition. You don't have to choose between VOO and SCHD. In fact, one of the cardinal rules of investing is to diversify your portfolio. By owning a mix of different types of investments, you can spread your risk and potentially increase your chances of achieving your financial goals. You could, for instance, invest a portion of your portfolio in VOO for growth and another portion in SCHD for income. Yet the key takeaway here is that there's no one-size-fits-all answer. Each investor is unique, with different financial goals, risk tolerances, and time horizons. Therefore, the best strategy is to diversify your portfolio to leverage the unique advantages of each ETF. Remember, there's no one-size-fits-all answer here. The best strategy is to diversify your portfolio to leverage the unique advantages of each ETF.